I'm still fascinated by the strategic partnership, quote unquote, between Sonder and Marriott. What did you think when you saw that press release?
I mean, my jaw hit the floor. I am so fascinated by the dumb decisions that private equity and companies will make all the time. I'm just floored by it. There was no sense in this whatsoever. I would love to know what the back end deal is. Unless Marriott is laundering money through Sonder Properties, I have no idea what's going on with this deal.
Straight Fire VR is streaming now, and we're pouring the fuel on the hot topics. High-tech PE moves? Will the latest deals be a white-hot winner or just a dim idea? Shining the light on these topics today are returning experts of the subject. On the inside track is the editor and founder at VRM Intel, as well as the brains behind DARM, Amy Hinote. Providing the data alongside her is the CEO at Key Data, Jason Sprenkle. Sounding off on the field, Intel is the Regional Director of Business Development at V-Trips, as well as the co-host of Straight Fire VR, Miriam Ramsey. Lighting up the subject today is the CEO and founder of V-Trips, as well as our host of Straight Fire VR, Steve Milo. Steve, please shed the light on this matter.
Hey, thank you, Heather. Great to be on. We've got an all-star panel today with Jason Sprenkle, CEO, Key Data, Amy Hinote of VRM Intel, and of course our co-host Miriam Ramsey. And Jason, I'm going to get right to it. We had Melanie Brown on a couple episodes again, and she was talking about a sad summer, that it was a sad summer in the U.S. I think some of her numbers were that occupancy for 2024 was looking like it would be at 43%, down from 46%, and obviously down from levels of 2018 and 2019. And yet Europe actually looks pretty good. At least based on the numbers I've seen and some of the reports from Key Data. So my question, why is the U.S. market doing so much worse than Europe?
Yeah, I mean, I feel like Europe's certainly having a better run this summer than the U.S. My overall view is that we just had a very different recovery out of COVID than they did. You know, our curve was more pronounced, both up and back down. They were later to come back out. And I think they're kind of still experiencing kind of the highs that we saw that were much more pronounced. The bounce back, kind of a 2-year euphoria curve has been much more steady. I think you add to that kind of the combination of the strength of the dollar, Taylor Swift in the Olympics. I mean, I think it's just been a good summer for Europe.
All right, so Amy, I'm going to ask you, because you get a lot of information as a reporter, as someone who is putting together a conference, DARM, coming up in early December. What are you hearing from property managers that are communicating with you? And why do you think, I guess, the U.S. market is off so much? It's really bad. I mean, it's not a good situation in the U.S. market.
There's the ultimate question is this a down market or is it a correction? I see a lot of signs pointing to this as a correction, and we had an inflated market due to COVID and some other external economic indicators that kind of pushed it, that made a really favorable environment for vacation rentals and excess inventory, especially inventory in non-tier or non-premier locations. So things that are off the beach, things that are just not where you would normally see vacation rental inventory. That stuff brings the numbers down when you look at that kind of tier 3, tier 4 inventory. I think too, I mean, what I've been hearing from the managers in Europe is they are down. I haven't seen, I mean, as far as the rural market, the beach, lake, mountain markets, I think the urban areas like Paris and some of the, like you said, the cities that have had the major events, I think have done well. But there's been a lot of backlash in tourism there too. So they're having to battle regulations there pretty strongly as a result. So, but the kind of the core vacation rental or holiday rental market isn't doing as well as they have in the past, or they were in 2023. So that's what I'm hearing on that front. But I honestly think that we have a real problem with our repeat guests in the markets, in beach, lake, and mountain markets.
So Miriam, why are we having so many problems with repeat guests? Why are they not coming back?
We're not performing. I mean, we're not giving, for one, we're not giving them what they want. But two, I think expectations since COVID is much higher than it was prior to COVID. Should it be? No. But I think, the supply and demand issue, and having, repeat guests is tough. Expectations are much higher. When they check in, they want X, Y, and Z. And they know if it's not here, we can check out of this place with some OTAs and go across the street and get checked into possibly something better. I think that is a huge aspect of what we are seeing in the markets right now. But I think
I
that
100% agree with Miriam on this. I think expectations and
mark this down at
I took my Prozac this morning. No, seriously, I do agree. It's the expectations and reality gap has gotten pretty big, but I think their expectations have gone up with the pricing. So it's like they're paying a lot more for the same product that they had. In a lot of cases, the product has actually deteriorated over the last few years. But on top of that, the market itself, there's so many issues in market. Lines in restaurants, not being able to get in to eat, traffic issues. The restaurant world got upended too over the last few years. So not being able to find employees at places. I think there are a lot of factors in the destinations that are pretty common across destinations, which I think Jason and his team are probably seeing at the DMO shows, that the destinations are losing some repeat guests on top of the managers too. But when you used to pay $2,000 for a week in Gatlinburg, and now you're paying $10,000 for a week in Gatlinburg, that is your expectations naturally are higher for what that experience is going to be.
And you're still getting that $2,000 property.
Right.
I don't think ADRs have gone up that high. They may have doubled.
But they have. But when you add the cleaning fee has went up drastically, and other fees that PMs have implemented, it almost has doubled and tripled in some properties.
I think it's worth discussing the future of fees too, because a lot of people are relying on that for profitability, and I think we've got some real challenges coming up over the next 1 to 5 years on fees being something that we're not going to be able to rely on in the future.
Yeah, Jason, so there's quite a bit to unpack here, and I know you talk to people both inside and outside of the industry. I guess the question is, do you think the vacation rental in the US is fundamentally broken, or is it just a cyclical situation? I mean, you've been in it long enough. We've seen cycles. We certainly all went through that 2008 to 2010 period where it was really pretty terrible because the economy was in a recession. Is it that there's a cycle here? Is it because the employment created such tight employment issues and restaurants couldn't find workers? Some of these places became just a headache to go to. Is it that, international travel was something where there was a lot of pent-up demand and people wanted to go overseas, and now they've kind of done that, and cruise ships to get people back from COVID gave these rock bottom deals, and now cruise ships are incredibly expensive. Is there a cycle here that we're just kind of not, we're singing the blues, so to speak, because we're at the wrong end of the cycle, but is this industry a cyclical one?
Yeah, that's my view. I mean, I take a very zoomed out macro view of we are just watching the pendulum swing back. I think there's lots of things that we should take the opportunity to improve on. And when you're down, it's a great opportunity to say, what can we do a whole lot better? I do think, people who were paying $2,000 before and are paying $5,000 for the same thing have $5,000 expectations and are getting $2,000 deliveries. So there's base stuff like that we can work on. But look, in the end, I think it's just supply and demand economics working their way through the system. I think supply is as these things become less profitable, and we see those curves starting to cross towards the end of this year, and we're watching them push out a month or two, and what I feel like is kind of the end of that cycle. Hopefully, it's always hard to tell with what the economy is going to do, but yeah, I think we're going to look back in a few years and say we've been up and to the right for a long time, and we've had a few bumps, but I'm still very, very bullish on the short-term rental space, our ability to capture market share from hotels. I think people got introduced to this stuff and love it. And there's things we can improve on, but yeah, I'm in the bullish camp.
Amy, are you a bull? Because as the revenue has dropped, everyone's costs have increased, payroll being the bigger one, but rent, utilities, cost of vehicles. I mean, everything has increased. And I'm sure you're hearing how many companies are in distress right now because, they can't get their expenses in line to match the revenue decrease. What are you hearing? What do you think?
So I think that the story in itself is very specific to a destination. I know Jason's job is to look at it from a macro view, but I think if you're communicating with a homeowner or trying to communicate within your teams, what's going on in every destination is slightly different or even significantly different than from one destination to the next, depending on everything from the economy to weather to employment. But also, I have to add to you, I'm shocked by how high technology costs have eaten into the bottom line. That is a line item that is very different now than what it looks very different now from what it used to in terms of percentage of revenue. So I agree with you that our industry has got some adjusting to do on the cost side of it. But I don't think that the industry is broken. I think that the industry that kind of came up in the last 5 years was not sustainable. So it's like the core vacation rental industry, where you've got people who want to own second homes and destinations, and they rent out their properties through a property manager to offset some of the cost of owning that home. In turn, what happens is over the next 10 years, that property appreciates. They're able to enjoy it for a while. They're able to cover some of their expenses, and they're able to sell it for a good bit more than what they paid for it. That's kind of the core of the industry. This idea of buying them as investments and living off passive income off these vacation rentals, I'm not sure that that's sustainable.
Well, let's talk about something that hopefully is more sustainable, Miriam. And that's the investment in technology. Because I think it's Amy hit the nail on the head. Companies are paying a bigger and bigger component of their G&A for technology, in some cases that they don't even know how to utilize properly. So, you've got your property management system, which has a core cost. Then you have pricing software. You might have other software that manages operations, business intelligence, etc. But if you don't know how to utilize those pieces, you're basically just throwing money away. Miriam, you've kind of seen some of this in your market, where we've kind of reorganized the revenue management team. It's now reporting to Amber Carpenter, who's now our chief marketing officer. And you've seen just in the last 30 days kind of the improvement, but it's complicated. And I mean, these tools are extremely complicated from setup, integration and API configuration. I mean, isn't it just really, really difficult now because you have tools that can do a lot, but if they're not set up right and the people aren't trained right, you just don't get the benefit.
Greg, I think that was one of our bigger issues. Amber and I had a conversation right after she took over, and we were waiting. One of our teammates had put in a request for a revenue projection to send into a realtor. 2 weeks, because it was not implemented into a process that we were actually paying for across the board correctly. No one was watching and managing that. So I step in, I'm like, hey, what's going on? But again, you can pay for all the technology in the world. However, if you don't implement it correctly and team members know how to use it, what are you paying for? And I think that's the biggest takeaway is, yes, technology is very expensive. Utilizing different platforms, whether it's for revenue, for operations, regardless, you have to be able to utilize it to your staff. If everyone cannot use it, it's a wasted toil and a wasted money from.
Jason, obviously I don't have to tell you how important technology is as the CEO of Key Data, but my question to you really is, what are some of the mistakes that you think property managers are making right now, particularly as it relates to fees? Because this has been one of the issues we've talked about, is that everyone is running fees differently. Some are rolling them into rent to try to get, kind of game the OTAs. Some of them are taking fees and parsing them into a bunch of different buckets. Some are rolling fees together, but it makes creating comps very difficult at this point because, and you obviously aren't scraping data like some of your competitors, but you're getting source data, but it's really tough from, from trying to run price management and revenue management tools with these fees that Amy and Miriam are talking about.
Yeah, I mean, a couple of questions there to hit on real quick. One on the technology spend. Look, I think there's great profit margins for this business if you're in it professionally, and there's profit margins that are sustainable even with these increased fees and lower revenue. So I think we're gonna do fine. I think Amy's point of like, jumping into it for a weekend investment is not sustainable, and we're seeing those guys get weeded out. On the technology, like, look, the space is getting more sophisticated. The operators are getting more sophisticated. You need smarter, more sophisticated people to run these tools and to compete. And so if you're leveling up your tools and not leveling up your team, I think you can run into a challenge. And I also think that's equally important for the technology teams to try to simplify the tools. That's one of our core focuses right now, so that the tools are as easy to use as possible. In terms of like mistakes that PMs are making and fees, like, I mean, two different things. One, I got a short list from my team on what they think the mistakes are that emphasize the pain in the US this summer. I'll read them to you real quick. Number one, they felt like, and these are from our customer teams who are working with 1,000+ pros in the US, they felt like collectively that we waited too long to drop prices. I think that's probably no surprise to anybody. I think we were banking on a shorter booking window. And I think it's self-materialized. You wait real late and then you have to drop them at the end, and then you do have a shorter booking window. We still see too many people trying to simplify bulk pricing changes, was number 2 on their list, which is like, you're taking the easy road. Get somebody more sophisticated in there who understands that these properties are very different widgets, and you can't just drop everything 15%. It doesn't work anymore. Rates were pretty high at the beginning, was number 3 on their list. And I think that just kind of waited too late to adjust them. Number 4 is people are doing a better job of adjusting things in the short room or short window, but they're still not thinking kind of 180 to 365 days out enough. And that's a booking window that needs more attention. And then lastly, the key data point is they're just not using the tools that they have in front of them to make as many smart decisions as they can. You've got so many more advanced tools than you had 2 or 3 years ago, and a lot of the teams just haven't leveled up to really take the data and use it. But fees is a separate point. And I do think fees is an issue. Like, we are finding that we have to think of ADR in a couple of different flavors. And I think it's incumbent upon Key Data to put a few different flavors of ADR out there. Amber from your team is, I think, one of the best in the industry at understanding that and has been working closely with us. But we can't treat all ADR as the same, apple. Some of them have fees in them, some of them don't. And you got to be real particular about how you're building these comp sets and what you're using for your pricing engine to feed it. And I think all of us need to get better at that very quickly, us included.
Amy, when you hear this, and you think back when you entered the industry, I mean, this is really complicated stuff, right? And there's so many principals, maybe less than there used to be, who entered this industry because they were relationship people. And then you have another wave of people who were, built their businesses on Airbnb, which was kind of an easy platform to use initially, but now they've got to scale and they've got to have a direct website and they've got to be multi-channel, et cetera, if they're going to survive. This is really complicated. And one of the reasons why I wanted to bring you on is 5 or 6 years ago, I've lost track, we started something called the Data and Revenue Management Conference, which was specialized in trying to bring people together and just dedicated to tracks on technology, revenue management, yield management, et cetera. Did you foresee that it would be this complicated today?
And to a degree, I mean, I certainly, we knew this is where we were headed, and that we needed to have strong benchmark data in order for people to even come close to making decisions. So the goal of doing this was to not only, now that, once we had the data, was to actually, start learning how to use it. I don't know that we've done a good job of that, as a whole, and I think that the conference helps, and it certainly gives us a chance to sit down with these technology providers and let the property managers actually talk to them about what's needed to build out comp sets. The revenue managers are able to sit down with the data providers and the revenue management tools, and executives are able to sit down with the software providers like you and Linda did, and really try to make some changes there. I think it's a really good tech forum conference for our industry. And it's a really good educational tool to really be able to, look at what metrics are we looking at? Are those the right metrics? And just having those conversations. That said, I do think right now that we've got to be really careful that we have data, but interpretation of data is its own thing. And you have to be super careful about who you're listening to. I mean, for instance, if someone's telling you that oh, don't worry about it, we're going to have last minute bookings, that's a concern, and then they don't appear, that's something that people are, weighing in terms of the forecasting. And I think that again, following through as far as learning how to interpret the data rather than just listening to the forecasting that's in the industry right now. One of the fundamentals of our industry, and you brought this up, and Miriam did last time that you guys talked, was that 40% of your revenue for the year should be booked by January. And I think especially in season, that is a fundamental that used to be something that was kind of an expectation, that you were not relying on last minute bookings to fill the calendar, that you had a lot of stuff on the calendar already by January for June. And I think that's interesting in the sense of when people are raising rates and when they're lowering them. I don't know, this idea of leaving money on the table and keeping the rate up through June is not nearly as important as getting a repeat guest back into their property. That's my opinion of it.
Yeah, well, we have learned some lessons in 2023. The lesson we learned is that we needed to go back to booking rules. We implemented those in 2024, and then and that was good. That eliminated a lot of the gap night issues. Our length of stay actually increased company-wide by 15%. And
what booking
we
rules in particular?
We went back to minimum lengths of stay per season. So believe it or not, after COVID, the revenue management people were saying, don't have length of stay because you're costing yourself revenue, because everything was booking. People would book 2 nights. People would book 1 night at a couple different places. It was unreal. It was also easier. It's easier not to have booking rules. We went back to dynamic booking rules. So this summer might be six days minimum, 5-night minimums with arrival or departure on a Saturday, 4 nights as you get closer in, 3 nights as you get closer in, etc. And then you relax that Saturday arrival at a certain point. But the goal is to maximize your booking calendar and to eliminate bad gaps that are basically unbookable. And that's what we were left with in 2023. We had occupancy, but they were just bad, gaps. They were, in the middle of the week during summer, and people just weren't booking those anymore.
We also screwed up with Christmas into New Year. So we didn't put booking rules into that. So you were getting both holidays for the price of one, realistically. So 23 at the end of the year. So they got Christmas, where if you don't, especially in my market, that's really the last 10 days of the year is one of the busiest 10 days of the year. What we done with no booking rules is they got Christmas and New Year's, where they should have gotten 2 different prices.
They were cherry picking is what Miriam is saying, is if you don't put those booking rules in, people like Christmas Eve, they like Christmas. We used to have 6-day minimums to prevent them just picking 2 or 3 nights. We want them to also stay the 27th, 28th, etc. Same thing with New Year's Eve. If you can just let people cherry pick, they'll pick the 31st and the 1st. And, when you eliminate booking rules, you really kind of mess yourselves up with these orphan nights.
It's a
You know,
return to the fundamentals, Steve. Like, I mean, it's the pendulum swinging back a little bit, right? Like all these tools have made it a lot more sophisticated, and there's a capacity to do way better yielding. There's also a capacity to kind of forget the fundamentals that got us here in the first place back in 2018 and 2019 before everything was automated, where we just understood exactly what was happening. And I think that's part of what you're leaning back into.
and then this year, so we did a good job this year with booking rules. That was great. Congratulations to the revenue management team. The bigger problem was, particularly in the first quarter, we didn't do a good job in pre-booking. So in 2023, 30% of July was booked in the first quarter. In 2024, that went down to 18%. So we kind of got lulled into, well, we'll book it. March, it all came in. It all came in the last 45 days. Same with June. June looked kind of scary. We had a lot of inventory open, and June filled in. Problem with July was we were close to 50% of our inventory still opened of what we projected on our budget. And then we got hit by bad weather. We had floods, tropical storms, and wildfires, and that scared people away. And so if you wait to the last minute, and then weather or some type of crisis happens, it can just destroy you. So, one of the things we're looking at and we're playing around with is, why not start to offer deals early to people to lock them in, right? We used to do that. We used to give returning guests an incentive to book in advance. We kind of got away from that because, again, during COVID, we were increasing rates. So why give a returning guest a discount on a rate that was below what we were charging now? So we got maybe a little greedy, right? And then second, homeowners were telling us, well, those rates were too low for 2021. For 2022, we want higher rates, right? And I think getting back to the basics of pre-booking, getting that booking funnel earlier, is incredibly helpful in terms of evening out the risk of last minute booking. So that's what we're doing.
You can yield to the higher rates, but if you start with the higher rates and refuse to leave, we're going to end up where we ended up this year. Like the rates are just too high is the shortest answer. Start with lower rates, fill some up, and yield towards them, right?
Right. Well, if all you do is start high and go low, you incentivize your customer base just to wait till the last minute, right? If that's the message that people get, is if they book a year in advance, they're paying the most, then only a handful are going to do that. Everyone else is going to wait. So you're better off starting early to offer discounts and incentive to people to book early, even if, quote unquote, you're leaving some money on the table. At least you're filling that pipeline. And again, we used to do that type of stuff. We, as an industry, we used to do that, and then kind of COVID kind of screwed us up because we kind of got greedy. Owners kind of got greedy. A $2,000 property for a week was now renting for $3,000 or maybe $3,500. Why pre-book it again for $2,000 when you can just open up that calendar and wait for somebody to pay $3,500? And obviously, as Jason said and Amy said, those rates weren't sustainable. Those rates that kind of went up and mushroomed up weren't sustainable, and it's getting back to the basics. So Amy, I guess we could talk about strategies, and we can talk about yield management all day. I think part of also what we want to do on this podcast is talk about some of the things that have been happening more recently in the industry that are of interest. And I'm going to switch this up because I'm still fascinated by the strategic partnership, quote unquote, between Sonder and Marriott. What did you think when you saw that press release?
My jaw hit the floor. I was like, I am so fascinated by the dumb decisions that private equity and companies will make all the time. I'm just floored by it. There was no sense in this whatsoever. I would love to know what the back end deal is. Unless Marriott is laundering money through Sonder Properties, I have no idea what's going on with this deal. So I was hoping maybe you could explain it to me.
Don't you think it makes sense from both of their sides? I don't know that it makes sense from the people who are pouring more money into Sonder, but I mean, for me, Marriott, it's a no-brainer because they get a free chance to book those things, and if it goes well, they get the royalty fees, they get more inventory, they get hotel type rooms in markets that they're not in, and what do they
Yeah,
got
but
to
what
lose?
was the
They didn't
money
buy
dump?
it.
144, 142 million into a
Yeah,
company whose
well,
market cap is 28?
From Saunders' perspective, it makes sense, don't you think? I mean, they didn't have
Oh,
a
it totally makes sense from
uh,
Francis's perspective. Why not, right? But this goes
with
back to Oasis and Lyric and some of the stuff like that that happened a while back. I mean, I don't know where they go. I agree with you on Marriott. However, I mean, the Sonder properties are not exactly quality properties anymore, like they've advertised. So in every destination. So I don't know. I feel like it's a bad mix.
but
I
Marriott
don't
did
think
put the
Marriott's
money into
quality
it.
and Saunders quality matches.
But Marriott didn't put the money in, if I understood the deal, right?
No, but they announced it together, which I thought was super interesting. Like, I don't understand that play. That's why I was asking. I really don't understand how the whole deal is structured. Do you know?
I mean, I think the guys were going to lose their money that they had invested in it, and so they took a bet that if they put more money in it in conjunction with Marriott, providing this new distribution, then maybe they would get more money back than just letting it go, take a dirt nap, so to speak. I think
Is
it was,
there any, I don't know. Is there
and
anything
that's where
in the deal that's very any different than someone listing their properties on Marriott? Okay.
so let's open up, kind of unpack this, because I think
Yeah.
from talking to some people, what I believe has happened is this partnership is going to be more like Le Meridian or Westin or Sheraton. It'll be a brand. Sonder will literally be a brand that'll integrate into the Marriott inventory. So unlike homes and villas where there's like a little banner, you'll actually see a brand called Sonder when you do a destination search. So if you search for Gatlinburg right now, you're not going to find a lot of hotel inventory there. But now with Sonder, assuming they have inventory in Gatlinburg, and I'm not sure they do, but maybe in Knoxville, you would see the Sonder inventory on the first filter. So that's one. Two, it's 9,000 units, room nights, which kind of backs into Marriott's growth. They forecast to the market how many rooms they're going to grow. And every year they provide a forecast. Interestingly enough, Amy, was not your friend Jenny Shea who was in the press release. It's a gentleman named Tim Grisius, who's the global officer of M&A and business development and real estate for Marriott International. So I have not seen the word homes and villas on any of this. So it looks like this is a straight out play for a vacation rental entity to be in the Marriott portfolio, like their hotel product and like some of the residences. Yeah, you probably have seen that Marriott has certain vacation rental residences, St. Regis and Ritz, etc. Well, the Sonder's going to do that. The second thing is, from the Sonder standpoint, they were on life support. Now, keep in mind, one of the things that happened here is Sonder raised over $1 billion. One of their primary sponsors was a fund backed by Lawrence Tozy. And anyone who doesn't understand who he is, he used to be the CFO of Airbnb. From what I understand, this was one of his biggest, if not his biggest bets after leaving Airbnb, was in Sonder. And so I think this money that's been raised, which is a consortium of additional money by shareholders, debt holders, and outside holders of about $140 million to pull Sonder out of the prospect of bankruptcy, is an attempt to get them to more of a hotel-like standard. And, given that they were sitting at a $20 million market cap, looking like they were heading for bankruptcy, the bet is that that with Marriott as their partner, they can build a brand. That's the bet. I mean, it's a hell of a bet. I'm surprised they raised 140 million, but I mean, Amy, beyond this, aren't you shocked that Sonder may survive while Vacasa dies? I mean, Vacasa can't raise any money, and here Sonder raises 140 million and does the sweetheart deal with Marriott. It's pretty unbelievable.
So the money that Sonder raised, is it debt?
It's a combination of debt. I think 80 million of it's debt, and then the rest is equity.
Okay.
So it's if you look at kind of the press release, the best was probably Focus Wire. They kind of break down where the money is coming from, and at least in the Focus Wire report, it was coming from a combination of debt and then additional equity from the some of
This
the
is kind of my question, and I don't really, and obviously the hedge fund money that came in for Picasso was also debt. I don't, and you built a lot of your funding off of debt too. I mean, correct in the beginning?
Yeah, so debt, now we're getting into the nitty gritty. I mean, debt is what a lot of private equity companies use to go out and grow their business because they're not using, investment money, right? So if you can get cheap debt, you can make exponential returns and grow your company. The problem is right now, debt is very expensive. So I'm not sure what the arrangement with Sonder was, but the arrangement with Vacasa and their deal appears to be at extremely high interest rate, almost like a distressed lender.
Like 11.25%, I think is what I saw last. But yeah, my question is, I mean, at some point, if you've got a company that is burning through cash, that can't pay back existing debt, cannot, kind of maintain value for shareholders, what happens when that debt cannot be paid just from a basic finance? I mean, like what happens then?
Okay, so in the case of either Sonder or Vacasa or any
Mhm.
company, typically debt has a primary lien on all assets. So if you get to a situation where you can't make your debt payments, then the lender has the ability to foreclose on the company and liquidate. So in the case of Vacasa, they tapped into the revolver loan on about $80 million. And then they have this, what I'd call subordinate debt that came in 25 or 30 million. And that would be in a secondary position, but it came with a bunch of board seats also, and then the ability to flex up to 75 million total. But if Vacasa can't meet their debt covenants or their repayment, those debt holders could foreclose on Vacasa and then liquidate the company. Same with
So
Sonder.
what does that mean to shareholders? I mean, because that means that as it gets liquidated, debt gets paid off first, shareholders second, right?
Yeah, I mean, it would mean that unless Vacasa sold for more than the notes that are due, the debt, the shareholders would be left with nothing, which is why the stock was in free fall. Sonder, the stock actually went up. I think these two deals are completely different. I think there's a belief that Sonder can build a hotel-like brand using vacation rental inventory, and that's a play, and some people actually put money in. Again, $80 million in debt, but $60 million in additional equity. That's the key there. Whereas Vacasa, no additional equity, only a high interest debt by a company that deals with distressed assets. So and based on where the stocks are going, it's showing the shareholders of Vacasa do not feel good about their prospect of getting a return.
Listen, I don't buy the premise that Sonder's going to survive and Vacasa's not. I'm not, like I said, Marriott's getting inventory for growth to meet their numbers, right? And they're getting a royalty. There's nothing for them to lose here in my mind.
So is this a branded deal like Sonder by Marriott?
Yeah, but I don't understand that piece either. I'm not sure Sonder should be distinct from Marriott Homes and Villas, but I'll leave that to the wizards. I mean, what I struggle to understand is the bet for the $146 million. I'm not saying it's a bad bet, depending on how much you had in the mix already, and it might be your best way out. But that's obviously a risky bet. I mean, they are betting $146 million with some debt in there that Marriott's shot in the arm is going to help Sonder survive. and the stock went up from whatever, $1 to $8. It's a little bit different game being played over at Vacasa, but I mean, both of them have plans to try to transform their business, and both of them are at risk of, being bought or broken up. And I think think it'd be interesting to watch.
Doesn't Sonder still have SEC issues?
Yes.
Yeah, that's a covenant for the money though. They've got to get caught up on their SEC filings.
He's on record.
So I want to talk about share shift. So about a year ago, Verbo was telling us they were in the midst of integration with Expedia and that they would be bouncing back in 2024 back to their levels of typical dominance, where, Amy, you can probably remember a time where Verbo, for most property managers in the US, was 80 to 90% of the OTA business. And the CEO of Expedia, Peter Kern, said the integration was over sometime at the end of December. And then the first quarter came in 2024 and Verbo continued to deteriorate. And then they continued to deteriorate again in the second quarter. And I think Jason Sprenkle pretty much called him out at the VRMA in New Orleans and said, it's not us, VRBO, it's you. Since that time, VRBO has pledged that they're going to up their marketing, that they're going to work on some of the configuration issues. But Amy, are you surprised by this? And I guess since we're trying to look at this more from a top level standpoint, is the marriage of Expedia and Verbo a toxic marriage? Because Verbo has never been able to get their inventory onto Expedia without property managers using channel managers. It's the most bizarre arrangement I've ever seen. And I can understand how it doesn't make sense to be marketing two different brands at this point, Verbo and Expedia, but you can't market Expedia alone if you don't have the VRBO inventory on the Expedia channel.
Yeah, I mean, they've never been successful at bringing on that inventory to the Expedia channel. I do like the new marketing campaign with Nick Saban. I think it's funny. Someone brought up today, I think on LinkedIn, that is it actually kind of hurting the category, because some of the things that Nick Saban makes points on are kind of true for vacation rental inventory in general. And so then the next step is Expedia actually purposely cannibalizing, its vacation rental inventory to drive people to hotels through the campaign. So I don't think they're that smart, quite honestly, to take that in the second step. But I do think their marketing efforts have stepped up on the consumer marketing side. As far as the way the inventory integrates into Expedia, the question is, should it be there? I've always wondered why it wasn't branded inventory for Verbo and, trying to really use Expedia to push the Verbo brand. Their attention's never been there. In fact, I wanted to ask you, Jason, do you have in terms of distribution channels, like where Verbo is in relation to Airbnb now?
Yeah, they're getting their, lunch handed to them. I mean, they're getting murdered is the shortest version. I mean, there was a big bet. Airbnb said, we're not going to cater to the pros. We're going to go get the hosts and we're going to bet everything on branding and we're going to try to win. And we think long-term, if we have the travelers, that will survive. And VRBO was, I think, good to host over the years, and they got into the spot where they were losing the branding war. Like if you go look at Google Trends, nobody searches for vacation rentals anymore. They search for Airbnb, and we can jump up and down and fight that and pretend it's not happening, but the data is clear. Like it's the Kleenex. I think it's hard to recover when everybody, who's looking for a VRBO starts by searching for Airbnb. And on top of that, VRBO had this tech debt that they had to correct, right? They were, or I guess that's a question, but they felt like they had to, merge the VRBO data onto the Expedia platform. And so they took this, big giant time off of marketing and converted all their tech over. And that put a company that was on a downward trajectory with their ability to gather hosts and fill up the units even further down. And I think they're trying like heck to recover. And they're certainly, making an effort, but the data is pretty clear that it is not recovered yet. We've been saying that since we started seeing it, and they say that we should expect a recovery any day, and we just haven't seen it yet. We're watching for it. Steve asks about it all the time, and it just hasn't happened yet. I mean, to your point on the data, yeah, VRBO down from 28% of our US pros reservations to 24%, Amy, in 24, and Airbnb up from 31% to 36%. I mean, direct and VRBO are down, and Airbnb and Booking are both significantly up, is the short answer.
But to be fair, I figured VRBOs was down more than 4%, honestly.
But by our numbers, it's pretty terrible. So give or take, depending on the quarter, you look at Vrbo 2 years ago was 82% of our OTA mix. It's down to about 43% of our OTA mix. Airbnb was at 11%. It's up to 33%. You know, you can clearly see that Airbnb has filled in. Booking.com went from 5 to 10%. So, you know, by any calculation, Vrbo has lost massive share shift. The bigger question was, you know, they initially said it was temporary. I don't know how they fix it because, Amy, you mentioned the branding issue. Well, either if you're going to be a brand, right, you either create something like Airbnb and build the direct channel, which Vrbo never did, or you try to be Expedia or Booking.com and you try to have all these other elements of travel. So when you pay to bring a paid search over, whether it's on Google or TikTok or whatever, they, you know, the traveler can book air, hotel, car rental, cruise, etc. Right? So there's so many more areas to monetize. That's how Booking.com has built their business model, is all of these different ways to monetize the guest, as opposed to just vacation rentals. So, you know, right now, Vrbo does not have a strong enough brand or a strong enough direct website. They had in the past, they were going out and paying for paid per click spending, and they pulled that back. I think some of it was integration. I think some of it was just so Expedia could make their numbers, because if you reduce the marketing spend, it, you know, they at least temporarily, you can pick up the EBITDA. I just don't know how this marriage works. I mean, to me, one of the things I've thought is at this point, Expedia might be better off selling Vrbo, and Vrbo might be better off being on its own again and letting someone in and try to see if they can figure out how do they compete with Airbnb. But someone would have to make a capital investment in Vrbo. And right now, Expedia seems like the worst possible fit for Vrbo of any entity.
I mean, I think across the board, the distribution side of vacation rentals is totally ripe for disruption. I mean, Airbnb, even though they're gaining market share, they've got their own problems too. And managers are really struggling, you know, with their relationship with Airbnb too. Booking, even though it's improving, is still not a significant provider of revenue in most of the beach, lake, and mountain areas. And so Vrbo is still, I mean, Vrbo is still pretty important to a lot of people. Somebody else could come along fairly quickly and do something very different. And I just think right now we will see, within my prediction, to Jason's, my bet is within 5 years, we will have a disruptor to the distribution side. Now, Google still has some opportunities there. We do have some outside speakers coming in, people outside the industry to Dharm on marketing, talking about Google updates, AI and large language models, where PPC is headed, and GA4, so that we can, because conversion tracking has changed quite a bit in the last year. So I don't know that we have a real good handle on the funnel, quite honestly. And that's affecting, you know, kind of where we are too. If Vrbo is going down, is that being replaced by Airbnb, or are those bookings just being lost?
But now it's being replaced by Booking.com to some extent in the US.
What is the breakdown again right now? Direct versus Airbnb versus Booking and Vrbo.
Right now, it's for key data, it's 36% Airbnb. These are reservations, 8%.
Is this US?
US, yeah. 36% Airbnb, 8% Booking, 32% direct, and 24% Vrbo. with direct and Vrbo both losing significantly and Airbnb and booking gaining significantly. Europe booking is up to 49% and Airbnb is falling.
I'm just curious, like, are these bookings that are lost, or are they going from one channel to another?
They're going from one channel to the other. And I think if you look at Europe, I think that's where it gives you a little bit better indication of what's happening, because booking.com actually is picking up ground against Airbnb. So the answer to your question, Amy, is whoever can leverage the audience from TikTok wins in this new world, right? So TikTok has become the big driver, in particular for the youth. Instagram maybe also, and Facebook to a lesser degree. But, you know, booking.com has spent a lot of time and a lot of money, and they're obviously very metrics driven, focusing on TikTok. And so, you know, they've been able to pull people to download their app. And they now, in the last numbers I looked on Folio app, they had 80 million downloads of the booking.com app in 2022 versus Airbnb at 52 million. So booking.com is rebranded themselves, something that I know we talked about. How do you do it? Well, they did it by being able to master new mediums like Instagram, Facebook, and in particular TikTok. And they've been able to become younger. And so whoever can figure out this, and part of it is your direct strategy that Jason talked about. Our direct numbers haven't gone down at all. We're at 60%. And it's in part because we're not using a web marketing agency. We're doing it internally. We've been pretty hands-on with email marketing, et cetera. And we've been experimenting with some of these different channels, like Facebook and other social media sites, not just Google or Bing. But, you know, it is possible if you go where the customer is. And right now, the new customer is TikTok. So maybe that's another one for Dharm, is to have a person who masters TikTok.
Well, if you believe the sell side analysts, bookings outpacing Expedia on AI innovation as well. Catch up for them to do.
Well, look, you can look at the chart, and booking.com is almost at its all-time high at $120 billion market cap. Airbnb has come back to earth at 70 billion, and Expedia is kind of stuck at 17 billion. So clearly the market is betting on booking.com, just purely based on execution. And they haven't even hit the US market the way they could or should. But I'm going to say at this point, we've come to the end, but I do want to give Amy one more chance to kind of talk about Dharm, which is coming up in Sandestin, Florida, December 2nd to the 5th. And she's got a couple guest speakers. So Amy, what do you want to say to the audience, and why should they attend Dharm if they have a limited budget?
Can I just say I've been going to 10 million conferences for 20 years, it feels like, and it's my favorite conference. Obviously a data nerd, and love you for what you built there. But if you're not coming to it, you should plan to come to it. It's a hell of a conference. It's what you said in terms of connecting all the thought leaders together so we can solve problems authentically. And I think it does a great service for the industry. So sorry, take it away.
Thank you, Jason. Jason's there, by the way. He's going to be giving us a breakdown.
What other
Jason,
reason-
we have decided on our data track that we're going to take one day and do deep dive into regions. That was a big thing that people were asking for. So we're taking some of those sessions. So we're spending an hour talking about the Panhandle. We're spending an hour talking about the East Coast, about mountain regions, and trying to get a little, so people can take a deep dive into their regional data. We're also going to be looking at property data in terms of what's going on within the property and how that's affecting rates. And that's something that's kind of a big concern for a lot of people right now, especially as they communicate to homeowners. On day 2, we've got a whole track of how to talk to homeowners about a lot of this. We have advanced revenue management and basic revenue management. So we have a track in revenue management, whether you're a beginner or whether you are an advanced user. And then we've also got a risk and revenue track this time where we're really looking at business risk and revenue streams. And so really putting a lot of effort into the business side of that. Marketing is looking amazing. That marketing track is a standalone. It's a boot camp in marketing right now. We do have a TikTok session, by the way. We also have one on social and influencers with Maddie Rifkin. And so that's looking good. I mean, honestly, the agenda looks stellar. It's hands down the best agenda we've ever had. We're a keynote speaker at the end, our closing. We're on the day 2, we're doing something a little bit different this year. We have Will Guidara back from Unreasonable Hospitality, and we have him back because he was so good last year, and we just felt like we could certainly use another hour with him to go a little bit deeper into what hospitality means in our industry today. But we're also adding a hospitality day. So kind of a separate mid-level management focus day that includes things around maintenance profitability using data and housekeeping, technology, customer service, reservations, front desk, a lot of the sides of the industry that we don't do. And we also wanted to celebrate the people in the area who actually work in those different departments. And we're closing the whole thing out with some bonfires on the beach and fireworks. So there's fun stuff too. We have on Monday going into the show, we've got pickleball, golf, a boat tour, spa day. There you can choose to do a lot of recreational things on the front end. But I do want to talk, Miriam mentioned something earlier that I think is really important that we're looking at too, is really segmenting inventory and not looking at everything the same way. So we're talking about this 5-bedroom houses, that really learning to focus in the same way that there are hotels and vacation rentals. Vacation rentals have a lot of property types under vacation rentals. So that's a pretty big umbrella of types of inventory. So really learning how these different inventory types behave differently, I think, is another focus that we have this year. And we do have a much larger focus on relationships at this show, really pairing people up, and so that there's much more of a networking, engagement, roundtable kind of feel to what we're doing.
All right. And you also have been generous enough to help coordinate with a big advocacy event for Florida. So we appreciate that. Tiffany Edwards is heavily involved. I'll be involved as well.
And she is planning a swanky fundraiser at Hotel Effie Rooftop.
Yes.
So, of course, we all know Tiffany doesn't do anything halfway. So it should be pretty fun.
It'll be great. All right. Hey, well, thanks, Jason, Amy, Miriam, for joining us on another episode of Straight Fire VR. If you want to look at past episodes, go to straightfirevr.com. Thank you again.
To watch previous episodes of Straight Fire VR, go to www.straightfirevr.com. For questions and comments, you can reach us at straightfirevr@gmail.com.